Hi, Mount Research, a monthly call for August 2023. Hey, everybody, Willie Dowich here. Glad you have tuned in. Glad you are listening. It is time again for our monthly research call where we try to step back, take a higher level view at what's going on in the market, what isn't going on in the market, where we see risk, where we see opportunity in terms of the path forward for stocks, for bonds, that sort of thing. So glad you have tuned in. Glad you're listening. I want to share with you what's on deck for today. Three basic themes that we're going to be talking about. The first part of the conversation is talking about some of the recent strength we've seen in the market. July was particularly strong. We've really seen this improvement in breadth over the past, say, 6 weeks, 2 months. Want to put that into some context. Then pivot in the middle part of the call to some of these differences between tactical tailwinds, secular struggles, some of what we're seeing from a weight of the evidence perspective. So while we're seeing bull market behavior, we're also seeing the weight of the evidence argue for caution right here. So I want to provide some context there and then wrap up with what we'd be looking at, where we're seeing some points of tension going forward that could, I think, give some evidence of whether the tactical tailwinds that we've seen over the past few months persist, or whether some of those cyclical and secular struggles that we've talked about start to weigh on what's really been a remarkably strong start to 2023, particularly from an index level perspective. So that's the roadmap. Let's get into it. Lots to look at. Let's begin with a recap of July. 45% of ACWI markets hit new 12-month highs in July. That's about half of the world. The best since mid-2021. Also, importantly, 0% of ACWI markets made new lows last month. So we've seen this expansion in markets making new highs, collapse in markets making new lows. That's typically a pretty good sign of strength. From the individual trends, individual market trends, we've talked about this a little bit in recent weeks, how from a trend indicator perspective, even though the ACWI index was making new recovery highs, we weren't seeing that from a trend perspective among individual markets. That now has resolved itself. New highs last week were accompanied by new highs in terms of our trend indicator. So breadth is confirming that index level strength. I want to take a look at the DeGraff breadth thrust indicators that we talked a lot about last year. Recall July of last year, and then again October of last year, we had these breadth thrust signals. In this case, we're looking at the percentage of stocks making new 20-day highs on the S&P 500 getting above 55%. I don't know for sure that that's exactly how Jeff DeGraff has identified these breadth thrust indicators, but this work for me is based on work from NDR, who took work from DeGraff. So they labeled it DeGraff. I'm labeling it DeGraff, even if it varies slightly from what Jeff DeGraff would argue from a breadth thrust perspective. Either way, it's very interesting. Look at what happened on the signal that just celebrated its 1-year anniversary. Through the first 6 months, the market was flat following that July 28th breadth thrust signal. That was pretty disappointing. Not the worst ever. You had down 20% in 2002. You had a couple other instances where it was down 6 months later. But the strength we've seen over the last couple months, that kind of saved the signal. It's not quite at the median, but certainly a lot better than it was looking at the 6-month level. You look at what happened since October, and that's been closer to the experience that we have tended to see following previous breadth thrust signals. Here's a breakdown on a day by day, blow by blow perspective. Orange line here is a composite of all those breadth thrust signals, and the summary statistics in the upper right there, just for perspective. You can see the July one, really was not keeping pace with the typical experience at all until strength over the last 2 months kind of brought it back towards the median. The October signal has been much more consistent with what we have seen, in aggregate after past breadth thrust signals. So, yes, history will say another successful signal based on what we've seen over the past 2 months, but if you look at it in context, I think the October signal at this point appears to have been stronger or more reliable than that July signal. The good news is that October signal is still in place. That goes through October, so another 3 months or so in terms of a breadth thrust regime, assuming we don't get another one, between now and then. And so I would guess perhaps we won't see another breadth thrust signal as possible, but in part because we've slipped into this environment of quiet strength, which is typically what you see in bull markets. Here, our quiet strength indicator. This looks at the number of days over the last 2 weeks where you've had the S&P move by less than 1% and more new highs and new lows. So quiet and strong. And you're seeing we're starting to rack up, some of those every day has been strong kind of environments. Every day's been strong. Every day's been quiet over the past few weeks. That typically when you see that expand, that's what you see in bull markets. That's not at all what we saw in 2022. So big shift that has accelerated over the past couple months. You see it from a day-to-day perspective here. We had 20 days in a row of more of the S&P 500 moving less than 1%, 17 days in a row. I think it actually ended up being 18 days in a row with more new highs than new lows on the NYSE plus NASDAQ. That came to an end this week. On Wednesday, we had our first 1% down day for the S&P 500 in several months. First 1% move in either direction in just over a month, and the first time in several weeks that we saw more new lows than new highs. So we're taking a breather from some of that quiet strength. Now the question is what comes next, and whether or not that signals an important change in the market. Remember, it's not the day-to-day signals. While we like to look at that and can talk about streaks and talk about extended runs, what we're really looking for is the trend in net new highs, and that continues to rise. One day down, even a second day down today perhaps, is not enough to shift that trend. We're at almost 40 days, so almost 2 consecutive months of more of the trend rising in terms of new highs versus new lows. You can see it start to turn higher ever so slightly. That green line is the cumulative net new highs number. Zoom out. And why is this important? Because typically that net new highs number, that trend that we're just looking at, that's the blue line here, that typically moves in the same direction as the S&P 500. So when net new highs are trending higher, the S&P tends to be trending higher. When net new highs are trending lower, the S&P tends to struggle. You can further expand it and say, okay, well, what sort of volatility do we typically see in those sorts of environments? When the net new high trend is rising, you tend to see strength and relatively low volatility. When that trend is falling, you don't see as much strength. It's on net positive, but just subpar, but you see a lot more volatility, a lot more chop, a lot more churn. And so in terms of fat pitches, in terms of looking for the market to be able to sustain strength, it's much easier and much more likely when we have the trend in net new highs rising like we have now, even as we start to get into a little bit more of a volatile period. And so that brings us to our bull market behavior checklist. And really, if we want to put any sort of market volatility that we might see in August or September into context, we want to first look at the bull market behavior checklist to see whether or not it's significant, see whether or not it's actually impacting these bull market behaviors that we've talked about. And this was as of the end of July, everything was signaling kind of bull market behavior, risk on, if you will. This is a combination of breadth indicators. So weekly new highs versus new lows, our net new high advanced decline line that we were just talking about, percentage of global markets above their 50-day averages. We'll put a pin in that. We'll come back to that in just a moment. The trend indicators as well, ACWI trend, S&P 500, and the direction of the 200-day average, the value line geometric index. We'll talk about that again as well. The trends there are rising. The breadth indicators are positive. So we have seen, particularly intensified over the last couple months, bull market behavior. So that underscores kind of this tactically bullish stance that we have taken. You can see just in terms of the score over time, At the end of May, beginning of June, just 1 out of 6 of those indicators was in positive territory. Now, as we finish up July, all 6 of them are in positive territory. And you can see, a reason why we like this sort of approach is when we get to 6, that's typically what we see when we're in established bull markets. We're not trying to call turns here. We're trying to stay in harmony with the underlying trend. And the trend right now is in favor of bull market behavior. Mentioned the value line geometric index. Long-term trend has turned higher, but if you look at it from a just what day-to-day price action here, is not a lot of progress. And so the downtrend was long enough that as we're now rallying towards resistance, that's turned the trend higher, but stopping shy of 600 again, not exactly confirming a lot of long-term secular strength in the median stock. And this red line here, that's 550. We've crossed above or crossed through it above or below, I think 66 times in the past 5+ years. So really want to get away from that level and start to make some sustained progress to the upside. Unfortunately, that's been hard to come by for the value line. And really, it's been a case of running over the same old ground for quite a while now. So that's kind of the shorter term, the tactical breadth and price trend backdrop for what we're talking about. You can see from a weight of the evidence perspective, those are on the opportunity side of the scales. Breadth and trends and momentum are tailwinds for the market right now. However, when we start to add in some of the sentiment picture, the valuation picture, the liquidity picture, there's more risks there than the price action is capturing right now. The change to the weight of the evidence this month, we took economic fundamentals off the risk side, moved them to neutral. A couple reasons for that. The economy has been resilient. Growth has not been robust, but it's been resilient and it's been better than expected. The economic surprise indexes in the U.S. at their best level, I think, in a couple years. Inflation is starting to moderate a little bit. There's some hope that maybe some of the strains that seemed inevitable earlier this year might not manifest themselves in that way. Do I think that we're getting set up for a period of sustained and rapid growth in the economy? No, I don't. But are some of the acute challenges for the economy starting to dissipate a little bit? Yeah, I think we'll have to watch and see whether or not they reemerge as we go forward. And I think the risk is there as kind of the effect of higher yields really starts to weigh on the economy. But for right now, I think having economic fundamentals at neutral is the right idea, is the right approach. And so then let's look at this from the perspective of inflation, the Fed, bond yields, and then transition into sentiment a little bit. And so lots of talk about headline inflation and core inflation. I think both of those miss the picture, and both of those are going to be noisy in coming weeks and coming months. My guess is that, so we've seen headline inflation come down quite dramatically. Chances are that's going to tick up a little bit in months ahead. And so people that have been talking about the decline in headline inflation are going to transition to talking about the decline in core inflation. I think skipping that altogether and just looking at what's going on in the trend in median inflation, probably the better approach. It's a little less of picking and choosing indicators to suit your narrative and just kind of being consistent with what you're looking at. Here we're looking at median PCE and median CPI. Both of these published by the Cleveland Fed. Blue lines are 3-month changes. Those have come down quite dramatically. Slower improvement on a 12-month basis. But even the improvement that we're seeing on a 3-month basis, probably not enough to really make the Fed feel comfortable that its fight with inflation is over. Encouraging, yes. A step in the right direction, yes. Conclusive evidence that no more rate hikes are needed and that we can transition to bringing rates down. I don't think so. I think it's still premature to think about it from that perspective. And so the Fed continues to raise rates. And interestingly, the rest of the world is increasingly raising rates as well. So what did we see over the course of July? We saw We saw Turkey raise rates. We saw Russia raise rates. At the very end of the month, we saw Chile actually bring rates down. So that's kind of the first rate cut of this cycle among, central banks that had been raising rates. So that's something to keep an eye on. Japan is not raising its rates, but it's letting rates rise. So it's kind of widened the bands on its yield curve control policy. The net effect of that is that 10-year yields in Japan now, rather being capped at 0.5%, now can theoretically drift up to 1% or so. Either way, you've got still a majority of central banks that are raising rates. And when that has happened in the past, stocks have struggled to make headway. The reason I'm showing this comparison right here is that in previous cycles, the U.S. actually was the leader in terms of tightening, and then also helped lead the way in terms of easing. This time around, the Fed, the U.S. was not in the lead. Emerging market central banks actually led. They've got more experience with inflation. Not too surprising that they knew what to do. Raise rates quickly is the developed central banks, the U.S., the ECB, the Bank of England, that were a little more laggard in terms of raising rates. And like I said, Chile, an emerging market country, has already started to cut rates. And so this could be a cycle where we have emerging markets lead the tightening, and then also lead the easing. We will have to see. In terms of yields in the U.S., big news this week with Fitch downgrading the U.S. credit rating. I don't know that has a huge impact on where yields go in the U.S. We'll have to see, and we can make up stories about it afterwards. But the reality is that 10-year yields were bumping up against their previous highs. 1-year yields had already broken out to their highest levels in basically 2 decades. So short-term rates, there was already upward pressure. Now this week we're seeing at the 10-year, 30-year catching up to that. Yes, it's happened after Fitch has downgraded the U.S., but I think it's more about dynamics within the bond market and this recognition of long-term trend changes in terms of bond yields, also inflation, that are catching up as much as it is any specific rating agency decision. And here, this is the 10-year T-note yield. Haven't broken out yet. We're a couple basis points shy of that today. I think the previous peak last year was 4.22% or so. I think this morning I saw we're at 4.19%. So we're getting close. But the bigger picture is the long-term trend in yields has been rising for 137 weeks and counting. The assumption should be that the trend will continue to rise, and that yields will break out until we see evidence that they're not going to. We trust that trend. And so the path of least resistance, if we're from a trend following perspective, is higher yields. That is a change in character over really the past 2 decades, or past 4 decades or so. Here's another way of looking at it. Top here, that's still the 10-year T-note yield and that long-term trend. On the bottom, this greenish line, this is a percentage of time over the past 5 years that the trend has been rising. And you go back to the mid 80s up until recently, it never got above 60%. So we never had a 5-year period where we had really for more than 60% of the time yields rising. That now has changed. That starts to look more like what we saw in the 70s and early 80s, where it never dropped below the mid 50s. And so that's kind of this long-term trend environment that's shifting. We've talked about this potential for a secular shift in stocks in terms of broadly sideways as opposed to this up and to the right period that you look at the past decade or so people have gotten accustomed to. I think we're seeing the same thing from a bond perspective, this shift in regime, the shift in trend that the market, I don't believe is appreciating right now. I still think there's this idea that is deeply embedded in equity investors, deeply embedded in bond investors, that any rise in yields is likely to be short-term and quickly reverse, because that has been the example, the experience for 40 years. You had these periods of lower lows and lower highs. That now has started to change. You had, just before COVID, you had a briefly higher high, then you did make a lower low, but now we're another higher high. So yeah, yields could come down for a while, but expecting the sustained decline in yields, I don't think that's the environment that we're in anymore. And I think investors need to catch up to that reality. Threw this in here, who owns treasuries, just to put a little context around the Fitch downgrade. Last time treasuries got downgraded was 2011. The rest of the world owned vastly more of our treasury debt in 2011, a decade or so ago, than they do now. That's come down quite a bit. Where have we seen an increase in ownership in terms of percentage of treasuries outstanding? It's been among households, and it's been among the Fed. The Fed for sure isn't going to adjust whatever it's doing from a treasury perspective because of Fitch ratings. And I doubt that U.S. households are going to make much of a change in terms of their bond market positioning because of Fitch rating decisions. The rest of the world, they've already started to dramatically unwound their almost majority ownership of U.S. treasuries. And that's been stable now over the past couple years. So then taking this rise in bond yields from a theoretical headwind and actually looking at it from an applied perspective, and we can do that through the lens of corporate bond yields. So this is the blue line, that's the BAA corporate bond yield. You can see, spiked to a new high now over the last almost a year now. It's settled into this broad range above where it was pre-COVID. Below where it was a decade or so ago, moving sideways, but still a little bit of upside momentum. Why does that matter? It matters because all of the net gains in stocks in the S&P 500 over the past 2+ decades have come when we've had downside momentum in bond yields. Rising bond yields are a headwind for stocks. It's not always immediate. It's not always a one-for-one basis, but the trend over time is that higher yields, particularly surging upside momentum in corporate bond yields, tends to weigh on stock market performance. That's what we're seeing right now. So from a liquidity perspective, from a bond yield perspective, those are some of the headwinds that equities are facing. Valuation perspective, stocks are expensive on an absolute basis, not as expensive as they were in early 2021 or early 2022, but they are, valuations have been rising, all the more so when you consider where bond yields are. And so I showed this last month and showing it again. This is a look at relative valuations, stocks versus bonds. So the green line, that's the S&P 500 forward earnings yield. So the expected yield based on earnings over the next 12 months. That's been coming down, i.e. PE ratios have been moving higher. The yellowish line, orangish line, that's a 1-year treasury yield. That's moving to new highs 2 months in a row now, where treasury yield is higher than the forward earnings yield for the S&P 500. Typically, we think of equity having a risk premium. In this environment, where we have a higher yield from treasuries, it's a bond risk premium. It's an equity risk discount. That's not something we've seen in the past 2+ decades. Historically speaking, we're no longer in the environment where stocks are cheap relative to bonds. Now we're at a point where bonds are cheap relative to stocks. That hasn't kept investors from turning bullish on stocks. That hasn't kept investors from piling in recent weeks and months into U.S. equities. But from a valuation perspective, stocks are cheap, stocks are expensive, bonds are cheap. And that fits with the positioning data that we're seeing. This is a AI asset allocation survey, monthly data. Stocks are overowned, bonds are underowned, cash folks don't have much interest in. And so stocks are expensive and overowned. Relative to stocks, bonds are underowned and cheap. I still think cash is underappreciated as an asset class, particularly in periods of volatility. So sentiment versus positioning. So go back to where we were On the AI asset allocation survey, 67% exposure to stocks in July. That's up almost a full percentage point from June. Here we're showing a scatter plot that AI data is on the vertical axis. We compare that to the Michigan Consumer Sentiment Index. Was interesting since the beginning of 2022, we had all these outliers every month from the beginning of 2022 through June of this year. So there should be 18 dots in there. We had this outlier where sentiment was depressed, equity exposure remained elevated. July is signaling something of a change there. So we want to pay attention to what's happening. It's moving back towards this historically normal relationship. I've been of the view, and I'm not convinced yet that it will turn out to be wrong, that the longer this persisted, the more likely we were going to have a rotation out of equities. So far, that hasn't been the case. And instead, equity exposures remained high. Consumers have turned a bit more positive. Whether they can hold on to that positivity remains to be seen. Also, if you look inside the Michigan consumer sentiment data, what you see is a spike in optimism among the top wage earners, whereas the bottom third of wage earners of incomes, sentiment remains depressed. And so we are seeing this reaction, I think. I don't know if it's a rate reaction where net lenders or marginal lenders are feeling good about higher rates, or those that have stock exposure are feeling good about higher stock prices. But certainly at the bottom, those who are net borrowers, those who don't have much exposure to equities, are not feeling any better now than they were or they have been over the past few months. Here, this is CBOE equities options activity with a spike in equity call data, about a 40% surge. So we're seeing more speculative behavior. Not only is equity exposure elevated, optimism is rising, but speculative behavior is coming back in. So that explains some of why we've moved sentiment from neutral to the bearish side, to the risk side of the weighted the evidence scales last month, and keep them there this month. Year-to-date inflows into ETFs. This is a surge in optimism we've seen over the past few months. The blue line there, that's cumulative flows into equities. Mid-April, there were actually net outflows from equity ETFs for 2023. And it was interest more in fixed income, interest in international equity. That interest has kind of persisted. They've continued to climb at pretty much the same rate over the past couple months, but it's been the surge into equity exposure that has been really interesting to watch. So from -4 billion on a year-to-date basis to almost 100 billion of inflows on a year-to-date basis. That's a lot of money flowing into equities. We see that in some of the sentiment survey data, AI data, showing the fewest bears in 2+ years. The investors intelligence data showing the most bulls, or the largest spread between bulls and bears since mid 2021. So we're seeing that optimism. And typically what we want to do from a sentiment perspective is go with the crowd until it reverses at an extreme. And that brings us to the NAIM exposure data. And you can see really from the peak in November of 2021 to the trough in September of 2022, in terms of the sentiment data, you had a relatively clean pattern of lower highs and lower lows. So as selling persisted, each surge in optimism stopped shy of where it had been. It was the crowd moving towards pessimism. Pessimism peaked in the late third quarter, early fourth quarter last year. Since then, it's been expanding. We've had periods of higher highs in terms of the exposure index and higher lows. Last week, we got above 100. That seems like excessive optimism to me. So we've met the one threshold. Go with the crowd until it gets to an extreme. So we've seen extreme optimism, and then it reverses. So now this week, a big drop down to 78. Is that a reversal? It feels like it to me. Confirmation will be if we make a lower low, so undercutting where we were at the end of June, that's just a couple points away. That to me would be a signal of a completion of this cycle, as we've gone from excessive optimism to excessive pessimism back to excessive optimism again. If that's the case, then it would suggest that the crowd optimism has peaked and it's starting to reverse. And so then we look lower from a sentiment perspective, not higher. We look lower from a price perspective, not higher. And so then what are the specific indicators that I'm going to be paying attention to as we go forward over the next couple weeks, maybe over the next couple months, in terms of any volatility that we're seeing on a short-term perspective? Does that have, is that lasting, that we need to get more defensive, or is it noise that actually helps alleviate a little optimism and ultimately presents itself as opportunity? First up, looking at the percentage of equity markets above their 50-day averages and above their 200-day averages. Remember, this is one of our bull market behavior checklist indicators. We're around 90 earlier this week, and we were strong too on a local currency basis. Now that's big drop back down to 66% in terms of the percentage of markets above their 50-day average. If that doesn't reverse quickly, that's a warning sign that we want to pay attention to. Sector level trends, blue line here, that's breadth trends at the sector level. This orangish yellowish line, that's sector trends from a momentum perspective at the sector level. Breadth trends still strong. We've seen some momentum surge and fade, but hasn't really broken down over the last couple months. That now is starting to shift. Momentum can be very noisy, so we don't want to act just on this downgrading in momentum, but eventually breadth tends to follow momentum. And so we've been in periods where momentum has been strong, our breadth has been strong, momentum has deteriorated, then breadth remains strong, momentum got back in gear. That would be encouraging. We could also get into an environment where breadth is strong, momentum fades, its recovery is not that strong, and then ultimately breadth, kind of joins momentum in terms of deteriorating. That would not be such a good development. So keep a close eye on this as we go forward to see, as we've gotten the spread now at the sector level between breadth trends and momentum trends. Kind of, does momentum get back in gear? Is this kind of a one-off period of volatility, or is this volatility and a weakness from a momentum perspective a prelude to breadth deterioration that we would want to really pay attention to and kind of follow with a close eye? We can also look at this in terms of dispersion between what the median stock is doing and what the S&P 500 is doing. Over the last couple of months, if we think about this from the January 2022 high, we've really closed that gap between performance of the S&P 500 and performance of the median stock. Median stock surged in Q4 of last year. First part of this year, it was the S&P 500, the Magnificent Seven, getting back in gear, catching up to the median stock. Now, over the last couple of months, they've moved together. If we see some sort of widening in terms of performance, in terms of how's the median stock doing relative to the index, that could give us some indication about what could happen going forward. Sector level trends more broadly. This is not the breadth trends, not the momentum trends, just price trends in terms of sectors above their 200-day averages. If we can keep this at 10, or at least keep it at 9, that's probably a good sign for the S&P 500. That's where we tend to see sustained strength. If and I just checked, as of yesterday, we're still at 10. So that's so far so good. As we go forward, if we start to see sector level price trends start to struggle, and we get back into kind of this muddling period of where the S&P churns more than sees sustained strength, that would be a warning sign. So far, not seeing it. And then finally, our fear strength model. We talked about net new highs earlier. This fear strength model overlays that, or adds into that, a fear element. And so see if we see net new highs roll over, but that's accompanied by a surge in fear, a surge in VIX above 28.5, then that keeps this model paused. If we don't see that, if we see a, net new highs roll over and fear remains subdued, that would be a warning sign. Right now we've got an absence of fear, even though the VIX is well off its lows. It's nowhere near signaling fear, but we are still seeing strength. And so this model remains positive. And that's, again, going back to 1990, that's where all the net gains in the index have come from. So not seeing a need from a kind of a tactical perspective to really make some changes at this point in terms of risk exposure. I said finally, but there's one final thing. Look at this from a long-term trend and allocation perspective. Just as long as we're still seeing rising trends, it's hard to get too bearish on equities. And that's what we're seeing across the board. Global equity, US equity, fixed income. About the only thing where we're seeing declining trends from an asset perspective is commodities. Would not surprise me too much if the next change in this is that bonds actually turn to a declining trend, that would be consistent with a breakout in bond yields, but that's accompanied by a turn higher in the commodities trend. The commodities trend has been improving, though it's not yet starting to rise. It's falling at a slower pace. The question then going forward would be, if we've got bond yields rising and commodities rising, what sort of environment is that for stocks in which to operate? So right now, that trend for stocks is rising. We'll have to see going forward if that changes. And if it does change, we can adapt to the situation as we see it. So that's the August monthly research call for high amount research. Just to recap, still seeing tactical strength. We've seen broad participation over the last couple months. Keep an eye on some of these indicators to see whether or not they roll over. So far, we haven't seen much evidence. It's early. The first 1% move in quite a while yesterday. So it's a little early, but these are, kind of laid out some of the guidelines for what we'd be paying attention to. But from a longer term perspective, want to keep in mind that this is an environment where bond yields are rising, and that bonds are a challenge for equities, unlike they've been at points in the past. And so we have that possibility of a secular shift, I think, is occurring in terms of bond yields and in terms of the trends for stocks, US versus the rest of the world, and then US trends overall. Let's see how that plays out. But right now, tactical strength, secular headwinds. If you're tactical, you lean into it, you persist. From a longer term perspective, it's still a less is more type environment. So that's it for this month, almost this week. That's it for this month. We'll talk to you again at the beginning of September, where hopefully we'll have a little more clarity about any sort of volatility that emerged this month and what it means in terms of longer term trends, in terms of the weight of the evidence, in terms of bull market behavior. Thanks for tuning in and thanks for listening, and I'll talk to you again soon.